Well, hello, gang. Steven Sitkowski here. Welcome to this week's edition of Market Insights. You can tell the background's a little different, right? Not in my home office. I'm actually in Sundance, the former home of Robert Redford. I mean, he was responsible for the development of all this property and um, sold it in 2020. And I'm on a little ski vacation for a few days. Absolutely gorgeous here. So 5 minutes after leaving you, I'm headed to the slopes. I hope you're having equally as good a day, or whatever approximates to that. Great day is different for different people. Certainly happy to have you with. Let's get to it. I want you to know that everything that we do here is for educational purposes only. It is not intended as investment advice. So what's moving the markets? Well, we've had a bit of a turnaround, have we not? Thursday, Friday, and then today, the markets look like they were going to try to recover some of the losses from the two previous trading days, but quickly this went south. Now, you know, I'm recording this early in the trading day. Maybe we get a bit of a turnaround. We shall see. But as of now, it just feels like the sentiment has sort of shifted. We went euphoric, confident, and now nervous. And there's a lot of unknown right now in the economy and in the marketplace. Wall Street doesn't like that. PMI services number came in indicating contraction. So the way that this economy has been running, services has been doing great. Manufacturing has been contracting. This last report, manufacturing expanded. So that's good news. Services has pulled back. So, the ripple effect of that is, gee, is the economy in trouble? Might be we headed for a recession, all of the hyperbole that you get. Even though it might be hyperbole at the moment, we definitely need to keep an eye on it. I think we're going to have a good barometer this week because both Home Depot and Lowe's announces their earnings, and they, of course, will also be talking about the economy and the economy's impact on their business. I did see this morning where apparently Microsoft announced that they were going to be spending less on AI. So a lot of people saw that as a red flag. Starbucks is laying off 1,100 corporate employees, trying to simplify their business. So again, is this the beginning of a trend? We won't know, right? Is it the beginning of a trend or just a hiccup? We got to watch. Tell you, part of the impact it's made is interest rates have come down. Now, lower interest rates, generally a good sign for stocks. So the 10-year has fallen below 4.5. It's at 4.414. And oil prices are, they've just been languishing in the low 70s, not doing a whole heck of a lot. What to watch this week? Nothing today, which is good for me because I'm not going to be watching anything. On Tuesday, the consumer confidence number comes out. Look, it's expected to fall from 104.1 to 102.4, and then we got a little Fed speak. On Wednesday, not much going on. Thursday starts to pick up. We get initial jobless claims, supposed to rise to 225,000, again, indicating a little less stoutness in the economy. Durable goods are actually supposed to go up. That would be a good sign. That's the spending on, washers, dryers, refrigerators, stove, things that last a while. The GDP number is supposed to hold steady at 2.3, and then a bunch of Fed speak. And then Friday, look at this lineup. Personal income, that's kind of a big deal relative to inflation. Personal spending, a big deal relative to the economy. PCE, that is the favored metrics from the Fed, it's personal consumption expenditure. again, relates to inflation. They're expecting, and if this happens, this could be a catalyst for the market, PCE to drop from 2.6 to 2.4%. They want to get that down to 2%. Core PCE might tick up month over month, and then year over year, they're expecting it to fall from 2.8 down to 2.6. So if that happens, it could be a good thing. Here's last week's heat map, whole lot of red. Interestingly, healthcare was green. So was Berkshire Hathaway's B shares, pretty heavily involved in insurance. Some companies took fairly big hit. JP Morgan, that's sort of surprising given the anticipation for, M&A activity. Broadcom was down, Palantir down big, 22% for the week. CrowdStrike down 13%. All of that comes as a result of an anticipation that we're going to be spending less money on defense. Tesla, Amazon, Meta, all down. Home Depot down. Same with Lowe's in anticipation of their earnings. We'll see how that goes. Utilities. So healthcare and utilities are considered defensive, along with the exception of Walmart, which gave disappointing guidance, consumer defensive or consumer staples. Those were all up. So we're seeing a shift, at least temporarily, from aggressive stocks into less aggressive stocks. When your heat map, this gives us some perspective. It's not like the sky is falling and things have collapsed. Apple's still up 35%, Amazon 27, Tesla 68, Meta 43, Google 26, Broadcom 74, NVIDIA up 100%. So there have still been some very strong pockets of the market. Consumer sentiment has ticked up a little bit since last week, but still well below historical averages. So historically, when you go to the independent investors and ask them, what's the market going to do over the next 6 months? Historically, 37.5 say higher, 31.5% say lower, 31.5% are neutral, 31% say lower. Now look where we're at. Only 29.2% say higher, and 40% say lower. So there's a fair amount of fear out there. Now, these economic numbers have led to an anticipation that it could cause the Fed to move more quickly. So, we were expecting a cut July, September. Some were expecting no cut for the year. Now that's been moved up. Now this is dynamic. That's why I show it to you every week. This has been moved up to June, and a second rate cut in December. So now we're modeling for 2 rate cuts and a third rate cut December of next year, but that's so far out. Nobody knows. 1-year sector returns. One of the things I included this time, it shows you a 1-year price range. You'll notice that with the exception of a few sectors, we're still, on the strong end. So if you look at the range for the S&P, which is up 18.32% for the last year, notice we're still far over to the right-hand side. Consumer staples are at their highs. So we're seeing this shift, like I said, into more conservative positions. But the big winners for the last year, communications up 30%, utilities 28%, financials 26%, technology 23%, discretionary 21%. Then we get a pretty significant drop-off. Staples, but boy, they have come charging back, up 14%, industrials 12%, real estate 8.83%, energy 5.46%, materials 1%, and the only loser, healthcare. All right, let's take a look at the charts. This isn't going to be real pretty. So, what we can see for the S&P 500, I mean, again, this gives you perspective. It's the last 6 months. You go, okay, so from left to right, definitely prices have moved higher. Yep. And we're just kind of sitting on that 50-day moving average, which many times will act as a level of support. So now the question will be, will we find support at this level? And in fact, the market has tried to come back a little bit this morning. Let's see if that's reflected in our 1 day. Yeah, see the little bounce? Not that that matters a whole hell of a lot in the grand scheme of things, but too early to press the panic button at this point and feel like, oh, the markets are collapsing. They're not. Here are the cues. Again, same kind of a picture, just sitting on that 50-day moving average. All right. There you have it, my friends. I will be seeing all of you, of course, next week. I'm going to go do some skiing. I hope you have a fantastic day. Bye.